Welcome to Any Answers Answered for March 2021. As ever, Tim and I will have a look at two of the questions from the pages of Any Answers. And our first question comes from a Ken Howard. And Ken asks, it's a different approach actually to whether a dividend is acceptable or not. And he's linking it to PCRT, professional conduct in relation to tax. The question quite simply is they have a business which has some profits, but rather than paying out these profits in one go, he would like to pay a dividend over a number of years. And he's been reading PCRT and is worried that the idea of highly artificial or highly contrived could be applied to something as simple as paying off a dividend over a number of years. Is he right to worry, Tim?
Well, interesting question, this one. And just to give a bit more of the background, the company was set up to do a barn conversion, which they've done. So it was what we might call a SAPCO, a single asset property company. And that company no longer has any purpose, presumably. The final properties are now sold. It was converting a barn into several homes. And we've got $250,000 profit, and there are two shareholders. And we're looking now at a cash-rich company with distributable reserves and splitting the dividend over 3 tax years so that none of them goes over 100,000 or 150,000, avoiding the loss of personal allowance, etc., does make sense. And Ken Howard's worry, as he says, that because this is purely for tax planning, tax reduction, could it be caught by the description in the PCRT document, the professional conduct in relation to tax agreed between several professional bodies? Could it be caught by the wording of highly artificial or highly contrived, or indeed caught by the general anti-abuse rule? And the answer is no, I don't think it could be caught at all. And if you have a look at the PCRT, then help sheet B deals with tax advice, and under the heading tax planning arrangements, it says members must not create, encourage, or promote tax planning arrangements or structures that ... We'll get to the ... in a moment, but the first clause of that might lead you to think, oh, well, this is a tax planning arrangement and we're not meant to create, encourage, or promote them. However, the ... is very important here. We mustn't create, encourage, or promote tax planning arrangements or structures that, 1, set out to achieve results that are contrary to the clear intention of Parliament in enacting relevant legislation, and or 2, are highly artificial or highly contrived and seek to exploit shortcomings within the relevant legislation. Well, would this idea of spreading a dividend over 3 tax years fall within either 1 or 2? Is it achieving results contrary to the clear intention of Parliament in enacting relevant legislation? No, I can't think of any intention of Parliament enacting any legislation that is intended to deter us or prevent us from spreading dividends in this way. What about 2? Is it, and this is what Ken Howard is particularly concerned about, is it highly artificial or highly contrived and seeking to exploit shortcomings within the relevant legislation? I don't think so. I don't think that that sort of timing decision in terms of dividend payments would, in a million years or a month of Sundays, whichever you prefer, be construed by anybody as highly artificial or highly contrived. Nor is it exploiting, even if it was artificial or contrived, it's not exploiting any shortcoming that can be identified within the relevant legislation. And if Parliament had wanted the distributable reserves to be taxed in the year in which those reserves became distributable, it sure as heck would have said so. So I think Ken Howard is being unduly cautious, but it's a very useful reminder that we should have regard to the PCRT when giving advice in connection with tax planning and reduction in tax liabilities.
Yes, having a focus on the legislation and on precedent and everything else is important, but also looking at what your professional body advises in this area. What PCRT, of course, now covers this for most people, most professional bodies covered by PCRT. Understanding exactly what they recommend as well is a fundamental part of what we need to do. So well worth looking at that document whenever making difficult decisions. Our second question this month comes from the rather wonderfully named Golden Fawn, who asks a question relating to the state pension lump sum rules. And the question, quite simply, is a lady will receive a deferred state lump sum of around £60,000 in May 2021, tax-free, because her other income in 2021 is covered by the personal allowance, and the lump sum is obviously therefore 0%. However, in the autumn, she will receive a capital gain of approximately £50,000. The question therefore is, does that £50,000 move the starting point? And therefore, quite fundamentally, do we have to bring capital gains tax into our decision-making process when we're looking at these gross payments, payments of the lump sums of pensions?
Well, the simple answer is no, but I think a bit of background here. The deferral of your state pension in return eventually for a lump sum is only available in respect of state pensions to which you were entitled before the 6th of April 2016. And it is very important to note two things. First, younger taxpayers, and I include myself in that category, are not able to avail themselves of the deferral in return for a lump sum. If you're talking to somebody who did reach state pension age before April 16, even if they've started to draw their state pension, it is possible for them today to decide to suspend drawing the monthly pension that they've been claiming since they reached state pension age before April 16 and defer any further payments in return for an eventual lump sum. I can't do that, but if I was 4 years older, I could do that, even if I'd already started drawing my pension, as long as I've not made any previous deferral. Now, what is the benefit of that? Well, the benefit is what this question in any answers is addressing. The tax treatment of the eventual lump sum is very interesting indeed. And this is why I regret not being older than I am, because as Golden Fawn points out, the tax-free status of the deferred state pension lump sum is what is at issue here. And these pension lump sums are not going to be tax-free automatically. The tax applicable to them, here we're looking at the client receiving about £60,000 as a lump sum later this year. Well, if the recipient's tax profile for the tax year about to start, 21-22, is such that there is zero tax paid, this is in simple terms, there is zero tax liability on income ignoring the lump sum, then the tax on the lump sum will itself be zero. Now, the question is whether capital gains tax comes into play here, because this taxpayer will, in addition to receiving the lump sum of 60,000 from the deferred pension, receive a capital gain of about 50,000. And that, of course, is going to be taxed at capital gains tax rates that depend on her income position. And the first point is that I can very happily confirm that in determining the appropriate income tax rate to apply to the pension lump sum, capital gains are completely disregarded. They, of course, trigger capital gains tax, albeit at income tax rates, but it'll be disregarded for the pension lump sum. So the straightforward answer is no, the whole of it will be tax-free on the information given.
And of course, this year we're going to see this as quite a big topic, because many people will have lower incomes this year for various reasons, and therefore will move out of 40% down into 20%. So we do need to consider this year particularly whether it might be a good year to take that money out of those pensions. That is all for this month. Next month, Tim and I will be looking at 2 further questions from the pages of Any Answers. But for this month, bye-bye.